Hi, good morning, everyone, and welcome to our very first webinar of 2026. Thank you to so many of you joining us. And as you'll know from the invite, we have Chris Saunders with us today. And if any of you were with us last year, we did a similar thing where Chris, or should I call him Madam Saunderino, had his crystal ball and he was looking out at what was expecting from 2025. So that worked really well, and we're going to look at doing a similar thing this year with his crystal ball again. So we're exploring about 5 different themes. So looking back to 2025, was it a steady grind? Was there any warning shots through 2025? Then he's going to explore the sort of last year's crystal ball. You know, which assumptions that we made at the time came true? Which are we going to revisit? Looking at the risks that clients may be underestimating coming into this year. And also we all know, the sort of AI themes quite prevalent within the New Horizon stable. So looking at that, is it maturing? Is it peaking? Is it just at the beginning? And then finally reviewing the sort of portfolios for your clients and the positioning and looking at whether there's anything unexpected and anything that becomes inevitable. So the usual format, if you're new to it, then it's basically a sort of 25-minute to 30-minute slides from Chris. You'll notice at the bottom there's a Q&A button. So again, as usual, if you have any questions as the presentation goes through, then please fire them into there. And we will have about 10 minutes at the end for Q&A. These sessions are always recorded as well, and they go onto our YouTube channel. So if you want to review it or come back to it at any stage, then they'll all be on our YouTube channel as well as all of our previous ones. So without further ado, I'm going to hand you over to you, Chris, and today's presentation. Thanks very much.
Thank you very much, Linda. Thank you all for joining today. Thank you for the opportunity to know Novia Global, of course. For those of you that don't know me from last year, my name is Chris Saunders. I'm co-founder and chartered investment manager at New Horizon Asset Management. We're a B2B service focusing on empowering financial advisors. It's really interesting. AI, of course, will be a prevalent theme throughout the presentation. You simply cannot move or discuss anything really at the moment without, of course, mentioning artificial intelligence. And some of the points that Linda made there, since creating the presentation or since launching the invitation, the market is moving so quickly at the moment. I've had to sort of move quite quickly and change slides at last minute. So hopefully today is relevant and is useful. My aim when I do any of these presentations is to try and give you information that you can use when speaking to clients. Okay, that's the most important thing here. And as we go through this, something that you want clarification on, perhaps you can wait to the end or even dive in. There'll be other persons thinking the same thing often if I mention something and it's not quite clear. So please do dive in perhaps with a Q&A. But as we sort of, I'm just going to share my screen here. There you go. That's the first hurdle that we've got over in technology, sharing the screen. I'm very pleased that that's gone reasonably smooth. And as I mentioned, of course, AI is prevalent and, of course, will be what we discussed today. Now, I don't want to spend too much time on 2025. The reason I don't want to spend too much time on 2025 is that we're almost in February, and I think we need to look ahead now. And not all of you will be investors with New Horizon. So some of the things will be, linked to how New Horizon have managed money in 2025. If you do want to have full access of our crystal ball for 25, I can give you portal access, which will allow you to download the crystal ball for 25, the crystal ball for 2026. But the first slide here hopefully captures 25 in a nutshell. Now, this is an AI-powered slide. I wrote a few bullet points, whacked it into Chat GPT, and this has generated this wonderful, well, I think it's wonderful. Nobody else is actually that impressed apart from me, but this is an AI-powered slide, which is making my life so much easier. This took me 60 seconds. The bullet points, of course, took me a bit longer, but it just demonstrates how productivity, of course, can be revolutionized moving forward just based on this slide alone. And this is me, who, of course, is the most uncreative slide generator you'll ever meet. But coming back to 25, This was the year that rewarded diversification. What does that actually mean? Well, in 23 and in 2024, diversification was dead. All you needed in 23 and 24 was exposure to equities and US equities and really 6 or 7 mega cap or magnificent seven stocks. That's all you needed, right? However, for the first time in 20 years, US exceptionalism was challenged. What do I mean by that? Well, the US actually underperformed and was the worst performing major equity market if you compared to the Nikkei, the MSCI Europe, even the FTSE 100, dare I say it, okay, and the UK FTSE All Share. So equities leadership shifted away from the US. That's the first thing, which is super interesting. So diversification was the key. And due to the macro backdrop, you had, of course, global growth held up, right? US recessions fears eased. Central banks delivered rate cuts as hoped. And of course, AI investment remained a key market driver. But what 2025 challenged was US dominance assumptions, and diversification for the first time in years paid off. Some of our best performing assets within the New Horizon models, which will be relevant to all of you, but were precious metals, were carbon offsets, were, of course, emerging markets. And all of these percentage returns that you can see here are, of course, in US dollar terms. Now, why is that relevant? Because one of the biggest drivers of markets in general in 2025, and is a theme that we need to focus on in 2026, is, of course, the performance of the US dollar. So whilst I am demonstrating on the previous slide fantastic return in US dollars, such as the Nikkei, 26%, emerging markets, 30% plus, it really depended on your base currency. Because if, for instance, you were in euros and you were investing in US dollar assets, euros, of course, appreciated just under 15% versus the US dollar. So this had a serious effect on portfolio performance in 2025. And it's something that is a key component of all portfolio management for ourselves, whether you hedge or whether you don't hedge your underlying currency. But last year, probably for 20 years, I would say the currency had the biggest effect on overall portfolio performance. Having said that, as I demonstrate to you, the backdrop was really positive. Despite this 2025 momentum, however, the feedback I receive from financial advisors, and you can put your hand up here if you want to, is that in general, underlying investors are still quite nervous. Now, this is despite of having 2 or 3 really strong years within equity markets. Investors are nervous through the negative news coverage they read on a daily basis. That's often linked to Donald Trump and volatility and geopolitics in general. The question we're probably all bored with is this an AI bubble? All right, and that's what everybody's talking about. And because we've had 2 or 3 years, a lot of investors are saying, oh, well, the market is due a correction. So I might be wrong here, but the feedback I get from our financial advisors is clients are sometimes putting off long-term financial planning decisions, which of course nobody wants to do here, okay? We're not into market timing, we're into long-term investment. So what I'm trying to do here is just now give you objectively what the conditions are, which then might help you when discussing with investors whether or not now is a good time to invest, okay? So I'm just going to give you this objectively, all right? Clients nervous about a market pullback. Okay, well, the first and foremost, okay, is we are only the 4th year into an equity bull run. The equity bull run began in October 2022. Now, why is this relevant? Okay, the average bull run duration is around 6 years and 10 months. This is a chart that I've sourced from one of the ETF providers that we use. Of course, I cannot tell you this year whether we will have a retracement of 10 or 15%. That, of course, can happen. But what I can tell you is that if you are looking at this in cycles, we are not done in terms of the average bull run duration. We're about 3.5 years in, average duration 6.10 months. That's the first, if you like, objective comment that I would make when discussing with underlying investors. The next, if you like, point I would make when talking about the big picture and equity market conditions. Now, remember, we're not just equity investors, right? So let's not get bogged down with equity. We, of course, manage multi-asset portfolios, which include equities, bonds, commercial property, infrastructure, commodities, currencies. So really broadly diversified. But let's make no bones about it. When you read the newspaper, you're either reading about equities predominantly, or, of course, bonds. But mainly clients focus on equities because this often forms a bigger part of a portfolio. Okay. So focusing on equity market conditions, the equity market conditions are risk on. This particular chart is a Bloomberg survey that they do at the end of every year, and they say to each of their investment managers, all the biggest and the best investment managers, all the ones that you would have heard of in the US, Europe, and Asia. And out of the 40 managers, they say, look, are you risk on or are you risk off? 30 out of 39 risk on. Okay. I don't make these things up. This is a well thought of survey that happens every year. Most money managers are risk on. Why are they risk on? Well, let's just look at the current conditions. Okay. Not US corporate earnings strength. Okay. We've experienced robust earnings over the last 3 years. Okay. Now, these robust earnings have been concentrated, which is what you'll see from this slide from BlackRock. They have been concentrated in the Magnificent Seven. So if you look in 2023 earnings and 2024 earnings, where were earnings driven from? Or where were the earnings or the change in earnings? So let me explain this chart. On the left-hand side here, we have the change in earnings, either 10, 20, or 30% surprise on the upside, or of course the downside. Okay, when companies such as the Mag 7 have reported, they have surprised or they have revised their earning forecasts by 30%. 2023, 2024, robust and growing earnings. Is that a positive thing for equity markets? Well, up until recently, because the market rally has been so narrow and has been focused on 7 companies, arguably, that's actually a risk, such concentration risk. But what we are now seeing, and this is in the shaded bar charts that you can see on the right-hand side here, is that earnings are now starting to broaden. And we are seeing change in earnings on the upside in the ex-Mag 7, in the S&P 493, for want of a better sort of description. Broadening, robust earnings is a positive for equity markets. Now, I'm focusing on the US. That isn't the case anymore. Prior to last year, again, it was all about US earnings dominance. That is now being challenged. The black bars here are the 2026 earnings per share growth estimates. As you can see, the third one in from the left, S&P 500, super strong. Has been for years and is in 26 and is expected in 27. But MSCI Emerging Markets is now catching up and overtaking, it is expected, in 2026. Even the MSCI ACWI, that's basically a world equity index, leaving out the US, that is now over the 10% growth estimate line. And even the Eurostoxx 600 is actually now catching up with US earnings dominance. So not only are we talking broadening in the US, which of course will always be the driver, but also we are seeing broadening global earnings dominance. Is that a positive for equity markets? Yes, it is. Coming back to the US, and here we go. This is the first crystal ball prediction and call, okay? And this is one we actually do believe in, is, I say, because the other crystal ball predictions are, sometimes they're grey swan or black swan to try and sort of provoke thought. But this one is actually, you can invest along these lines. US small and mid cap stocks will outperform large caps in the US. Why? Because lower rates are improving the outlook after years of underperformance. Okay, so there is small cap optimism. There is mid cap optimism. Okay, so the earnings outlook has now brightened for smaller and mid-cap capitalization stocks, industrials, and financials. All right, is this positive? Absolutely. Okay, and this particular chart is demonstrating the Russell 2000 relative to the S&P 500 over the last 5 years, and which is, of course, now starting to pick up. Now, this is another AI generated slide, which nobody else is as excited as I am. But I am super excited about this slide because it took me probably 30 seconds to generate on ChatGPT. And here I just wrote in the fight between Donald Trump and, of course, Jerome Powell. But the real message here is interest rate cuts. Okay, whether you're looking at the UK, whether you're looking at the US, there is a moderating trajectory, or there is an interest rate cut trajectory upon us. Now, there might be even so that Trump is obviously trying to lock up the governor of the Federal Reserve to get what he wants, and this is the chains on Jerome Powell, which is detail. Okay, AI detail. I'm very impressed by that. But the point that I'm making, if you're looking at conditions, interest rate cuts, interest rates coming down, is that positive for equity markets in 2026? You'd argue so. Inflation. Is inflation coming down? So I was reading last night, actually, thankfully I did. You look at the IMF reports and look at, inflation in the UK. It's heading now down towards 2%, which is the target for both the UK and the US. Last week, we saw the same in the US. Inflation is moderating. Okay, I can't say anything else to you. Is that positive for equity markets? Yes, it is. Now, since writing this presentation, one of the risks to that, of course, is tariffs. Now, tariffs were one in which we felt that things were sort of actually, settling down, quite frankly. But of course, as we've seen in regards to Greenland, the weaponizing of tariffs, of course, could have an effect on inflation. That definitely is a tail risk that we have to be aware of, something we need to focus on. But currently, taking in consideration the tariff tantrum in 2025 and the effects that has had, we're seeing inflation coming down. Okay, positive. Global growth. Now, I don't want to be over positive here, okay, because there are risks and we'll come on to these, right? But I'm just giving you the facts as they are, or the trajectory or the projections. Global growth. If we look at G20, which is the 20 largest economies in the world, global growth is estimated anywhere between 2.5 to 3%. Okay, the UK, of course, lags way behind that. So I think it's around 1.3%. The US is closer to 3%. Okay, but globally, we are looking at robust growth in 2026 due to a number of reasons, capex, but this is positive. And within there, if you're selective, India, 6.2% growth projected in 2026. Indonesia, China, Turkey, as well as your developed market countries. Okay, none of these, of course, are certainties, but what is certain is we are seeing increased capital expenditure and we are seeing a reduction in interest rates across the board, which, of course, is having an effect on global growth. The last point I'm going to make about conditions is liquidity. Now, I sometimes bore people about liquidity, right? But basically, liquidity is the fuel in markets, not just for equities, for bonds, but let's focus on equities because I think clients focus on equities. Liquidity is the fuel. Now, what do I mean by that? Well, since the global financial crisis in 2009, we, of course, had quantitative easing. Quantitative easing adds liquidity to the system. Okay, essentially, it gives you more reserves to be able to buy assets. So the Federal Reserve essentially prints money, and of course, we then see the purchases of treasuries in the US or gilts in the UK. Quantitative easing, of course, we saw from 2009, and of course, that supported the system in general. So when QE adds liquidity, the QE is when the Fed buys bonds When they do that, they create reserves in the banking system, so there's more cash about. This is then supportive of equities because financial conditions loosen. Then you've got the flip side, which is what we've experienced over the last few years, which is quantitative tightening, which is draining liquidity. This is a headwind, arguably, for equities, okay, because it's the reserve. It's when the Fed reserve or shrinks its balance sheet. That drains reserve from the system, and that's what we've experienced up until the 1st of December 2025 in the US. So when liquidity reduces, it's usually a slight headwind for markets. And how that happens is when these bonds expire, rather than repurchasing, the assets go back to the Federal Reserve in simple terms. What nobody seems to be talking about, and again, I bore people on this, all right, is that we've seen in the last 2 months an amendment to the supplementary leverage ratio in the US. What is this? Well, a supplementary leverage ratio is adhered to by all of the big investment banks, and they basically need to ensure that when they expand their balance sheet, they've got to ensure they've got enough cash, which basically supports those positions, right? So it's a rule that basically limits how big US banks' balance sheets can be. And it even includes safe assets such as US Treasuries. So if you want to buy US Treasuries, you've got to ensure that you've got the cash reserves there to do it, right? So when banks get close to the SLR limit, they then tend to step back from holding Treasuries and from market making, right? And this is what this ratio is designed to do, right? Stop taking risks. Now, this matters because banks, of course, are the shock absorbers in the Treasury market. So if they can't absorb supply, bond prices fall and yields rise. And higher yields puts pressure on equities. Now, why the easing of this SLR, so this has been taken off now, okay, supplementary leverage ratio, is that if regulators ease or recalibrate the SLR, banks then get more balance sheet capacity. That means that they can hold more treasuries, because which then means they can provide more liquidity. So bond markets then function more smoothly, yields are less likely to spike, and that indirectly supports equities. So it's not like QE, because not many people are talking about it, but it is a quiet thing or quiet loosening of liquidity conditions. So QE, that adds the fuel, QT takes away the fuel, but SLR easing, which is what we're seeing, adds some of the capacity. So it's almost like sort of QE through stealth. I mean, it's not, but do you know what I mean? It's like a stealth support for risk assets. Liquidity is improving. That is a positive for equity markets, or that is a positive for assets. I don't think many people are talking about it. Hopefully, I haven't bored you to death on this slide, but I think it is important to focus on liquidity. So to summarize the conditions, I'm not going to discuss all of them because we've gone through them, but we've got a very supportive Trump administration or pressure. Liquidity is improving, robust earnings and broadening. I mean, this is positive for equity markets. Risks. Okay. I'm conscious of time, Linda. So perhaps you have to dive in or push me along here because we've got a few more slides to get through, which I'm going to be trying to be as quick as possible here. But what is it? What are the risks? Well, this is a fantastic global fund. This is a Bank of America global fund manager survey. I look at this every quarter. What are the biggest and best managers nervous about? Investors, money managers see the AI bubble as the biggest tail risk. Okay. Now, of course, we know that AI is the dominant megaforce right now. It's helping propel US, but global stocks. This, of course, is something to be nervous about. We can understand that. And in recent months, investors have started to fret about equity valuations and whether this AI bubble is forming. You read this everywhere. If you look at the Schiller price to earnings ratio, this does show the stock valuations are perhaps the most expensive since the dot-com or the 1929 bubble. Absolutely. But we are not at the 1929 depression, and we are not at a dot-com bubble. Okay. In the dot-com bubble, you had companies which, of course, had no earnings, no profitability. When you look at the Magnificent Seven, okay, and I'm just focusing on them at the moment, and we'll go broad in a moment, but big tech valuations are below historical peak, and P ratios are only slightly higher than the 10-year average. Now, I'm focusing on Apple's, Amazon, Alphabet, Microsoft, Nvidia, Meta, Teslas, all the big companies here, okay? But these companies, of course, are hugely profitable, are generating liquidity, or they're generating free cash flow. I think Nvidia generates around $1 billion US of free cash flow every single year. We are talking about huge, profitable companies. So American exceptionalism is far from dead, and these companies are far from dead, okay? But of course, you do need to diversify. And when you look at P ratios of anywhere between 20 to 50, that does look punchy, but you're looking at earnings growth of anywhere between 30 to 40%. So the fundamentals are there. But let's not focus on Magnificent Seven, because quite frankly, we do look at diversification, and you do need to diversify. And that is one of the themes this year within all of our portfolios. But coming back to this AI bubble, European tech stocks are now catching up. Now, we've seen a 10% rise in European stocks this year, okay, or European tech stocks, which has been driven by mainly the chip stocks, the ASMLs and whatnot, okay? So we're seeing a broadening globally, if you like, in terms of, AI support or the AI mega trend, okay? So this is super important. I'm not going to be positive for positive sake, okay? That isn't the reason here, but we are sort of on a trajectory which arguably has only just started. Now, I love this chart, okay? This chart I've stolen from BlackRock, okay? And I'm just going to demonstrate to you why this is so massive, quite frankly, for want of a more technical term. This particular chart focuses on, if you like, AI investment and the potential transformation. What we are seeing here is capital expenditure on a scale that we've never seen before. On the left-hand side, the axis on the left here is the capital, or the capex spend, or the capex contribution to GDP, right? Because capex, okay, arguably drives GDP contribution. That's the argument here. And on the bottom axis here, you see all of the different impacts of innovation over the last 250 years. So, for example, steam took 50 years really to transform things. Sorry, 250 years, I should say, okay? 250 years between 1760 and 1910, okay? Sorry, 150 years, it's early here. 150 years, I should say. The effect that had was around 15% in terms of GDP percentage points. But that was over 150 years. If we looked at IT, okay, from the 70s to 2012, we're looking at broadly 50 years or 40 years there, okay, in terms of the length of transformation and the potential that this added. When it comes to AI, we are looking at half the time and almost as much sort of capex over a shorter period. Now, why is this important? This is one of the biggest shifts in markets today. So for the last 10 to 15 years, okay, investors have been rewarded for sort of capital light growth. So things like software and platforms and high margins and low capex. AI completely flips that because it's not capital light. It's absolutely massively capital intensive. So to build AI, you need to scale. You've got to have infrastructure such as chips and data centers and grid upgrades. All of this, of course, is really capital intensive. And of course, this adds value because you're expanding, sort of workers, and other industries, of course, have an effect. So the winners are not just going to be obvious, they're not just going to be AI names. Okay, that's something to sort of push here, is that this sort of digital growth, or we're moving from sort of digital growth back to sort of an industrial style growth because of this build out. So this opens up a much wider opportunity set, and arguably you've got to be a bit more active because there will be winners and losers, absolutely. But it's worth sort of really focusing on this capex story and me trying to sort of hopefully present this slide clear enough, because it really is almost the sort of engine of the whole AI story. Because capex is not just about spending money to build things such as the data centers. It really drives economic activity. And when it's just small, based on companies, it's concentrated. But now this is becoming a macro story. And I think BlackRock says something is micro is becoming macro, because a handful of these companies are now moving the economy. And I think depending on what sort of source you read, external estimates are suggesting that the AI build-out could mean 5 to 8 trillion of capex through to 2030, mostly concentrated in the US. So this is not just a normal tech upgrade. It's investment big enough to move the whole economy. And this is really important because capex, as I've touched upon, as you see from here, that's a growth impulse, which is why, again, it's positive for equity. So it's not AI is not going to, not all boats are going to rise here. There will be winners and losers, but overall, I mean, this building of capacity, is going to have a real effect. And arguably, we're just getting started. And there, of course, there's risks, of course, because this is front-ended. So CapEx is, you've got to pay up front, and then hopefully the revenues come through, of course. And, there might, of course, need to be pivots. And this is a chart that I've also stolen from a tech manager, actually, which I really like. And this looks at the impact of AI and the impact of innovation in general. And this is really important because structurally, AI is having a real effect on other industries and other technological advancements. So you might have seen this slide from me before or from the manager themselves. Okay, this is a manager sometimes we look at. And this is identifying the impact of innovation over the last 250 years. So it's going back to the steam engine and railways, and this is what all these dots are. And they are arguing ultimately that, we're on the precipice of the largest technological transformation in history. I'm not here to debate that. What I am here to debate is that AI is the glue, or it is the power which drives advancements in genome sequencing, so healthcare, blockchain technology, robotics, autonomous technology. All of these are interlinked. So not just the CapEx that we've discussed, but AI almost innovates, AI almost innovates the way that we innovate. So there'll be pivots and there'll be industries that we don't even expect or even know about. And arguably, we're just getting started. And that doesn't mean that we're not going to have a retracement of 10 or 15%. Of course that can happen. And that doesn't mean that there won't be winners and losers, but really AI, CapEx, earnings, productivity. We are undergoing a productivity revolution, as you've seen from the slides that I generated at the start here using AI myself. There you go. Okay, that's a bit of a joke, obviously. Geopolitical risk, another risk or another mega force. Depends on how you look at it, okay? What do I mean by that? Well, look, the first mega force, the first mega trend we've discussed, of course, is AI. That's the biggest, I would argue, but also geopolitical fragmentation. The world is changing. All right, there will be winners and losers. Okay, but we've now entered arguably the sort of a new world order, which fundamentally resets the sort of economic and geopolitical relationships with the world. This is all down to the US, of course. It's now becoming transactional. I mean, I can't keep up with the various things that Trump comes out with each day, but this is different. This is a decisive break from post-Cold War. Okay, the US-China rivalry is essentially defining the feature of geopolitical politics. Trade, technology, energy, defense. There'll be winners and losers again. But this particular chart, again, this one is from BlackRock, actually, which I like. This is defense spending in Europe. Prior to Trump, okay, defense spending by NATO was below or was around 1%. There was a previous target of 2%, but everybody lagged it. This particular line here, first line here is Germany. And the second line is NATO, the European powers in NATO. As you can see, due to this deepening geopolitical fragmentation, this has now increased urgency, and everybody is spending on defense, cybersecurity. So there, of course, are sectors which will benefit from this geopolitical volatility that you are seeing. Okay, again, and industrials, but again, there'll be winners, there'll be losers, because defense spending now, as you can see, and this is what this takeaway here is, defense spending is now seen to be boosted to 5% as a share of GDP by these NATO allies. Why Russia, as you've seen, US changes? It's a game changer. It's a game changer. You see, of course, when the US invaded Venezuela, oil hardly moved, right? You'd expect oil to move. Oil hardly moved. What moved? I think defense stocks jumped about 7%, world defense stocks. And defense stocks in Europe jumped around 12. Don't quote me on those exact numbers. They're there or thereabouts, but it gives you an idea of what people are focusing on. Our crystal ball grey swans. What is a grey swan? Okay. A grey swan event, okay, is a low probability, high impact event. Okay. So a lot of these crystal ball calls are to spark debate. And if you want to have full access to all of the calls, then please drop me a line. I'll give you access to the portal and you can generate them yourselves. But to focus on some of these, one grey swan event is, of course, Le Pen for president in France. Okay. Now, our crystal ball, okay, believes that actually, yes, there will be a French government collapse, which will lead to a snap election. But it's always difficult to predict politics. But France, of course, has been in deep political gridlock since the snap elections in June 2024, which produced a fractured National Assembly with no real party holding a clear majority. It's also, headed in, it's currently sort of having a problem over the state budget, and the lower house failed to pass the 2026 budget. So, this isn't a big call really, but a fiscal crisis would be highly unusual. And that could lead, of course, to Le Pen becoming president. Grey Swan, I think so, because this could unsettle both markets and other EU members. Farage for PM, okay? We disagree with this in terms of we think Sir Keir Starmer will remain Prime Minister, but there is a genuine belief that he could be out. However, look, even if the polls fall sharply, parties don't tend to remove leaders mid-term without extraordinary circumstances, but of course it could happen. It could happen. It's a grey swan event to be aware of. That would, of course, have a huge effect on the UK. Another grey swan event, which I disagree with, but sterling will weaken in 2026 and end the year approaching $1.20. I think we'll still see US dollar weakness, but what do I know? There could be, of course, an OPEC price war. That is definitely a grey swan event. Our crystal ball states that we think price of oil will remain below $65 a barrel. Okay, but something to be aware of, certainly with Iran, certainly with Venezuela. Another grey swan event, which I think is actually caveat perhaps some of my positivity towards the AI mega theme, is that the model of the copyright uncertainty will derail the AI juggernaut. Now, what do I mean by this? Well, look, the model of trailing, or the AI model is essentially training on everything on the internet, right? This model is now starting to run into lawsuits, new regulations, and probably a wave of court rulings which will decide whether AI firms can keep using copyrighted books, articles, code, and images without the permission or payment. If they can't, that could force a very messy, expensive pivot to licensed data and royalties. This shift, it'll hit profit margins, it'll scare off some investors, and could likely leave only the well-capitalized players standing, which of course is a negative because, if you've got to pay for a license, that means you'll only have the sort of big companies which are controlling AI. And of course, the cost base will explode because it'll move from free internet data to licensed data sets. Whether or not this will happen is another thing that could slow innovation. All right, because every training run requires, permissions, contracts, royalties, approved data. This adds friction. I'm putting it out there because it is a risk to be aware of when discussing with clients. Just conscious of time here, guys. 2026, sorry, excuse me. I'm now going to sort of explain our position really, really quickly, okay? And Linda, please dive in because I'm not sure on the time constraints here whether we're up to the half hour because I've just sort of focusing on these charts here and I've realised I don't have my mobile phone next to me to look at the time.
Don't worry. Yeah.
So just dive in with the old sort of shepherd's sort of hook.
Yeah, another few minutes and then we'll crack on with the Q&As. Yeah.
3 minutes, guys. Okay. Our positioning. Equities, of course, will form a big part of our positioning. Of course, they will. Infrastructure, though. Okay, there is a valuation discount between listed infrastructure and MSCI World valuations. Essentially, as you can see here, infrastructure such as property, it trades on a premium or discount. There's roughly a 20% discount to listed infrastructure. We are looking at infrastructure. We're looking at to add infrastructure as this is creating a very attractive entry point. So infrastructure broadens the diversification within our portfolio, and that is something that we've added to. Precious metals, obviously, that was a great position. Our biggest, probably our best performer last year was precious metals, gold, silver, also carbon offsets. Commodities and having that diversification really changed the landscape last year. We did extremely well because of that broad diversification. We maintain our exposure to precious metals. I think we have a crystal ball prediction that gold might sort of retrace to $4,000 an ounce. That being said, you have to maintain precious metals in this environment, certainly with the volatility that we've experienced. Our positioning, emerging markets. So post-tariff world has looked like a win-win both for the US, S&P 500, the blue line, and the black line, the MSCI Emerging Market Index. Okay. Now this is big stuff really, because emerging markets had a fantastic year in 2025. There's an inverse relationship between dollar strength and emerging market weakness. So if you see dollar strength, emerging markets often underperform. If you see dollar weakness, that often adds fuel to emerging market outperformance. That being said, the fundamentals of emerging markets, such as India, superb. We are buyers of India. We are big buyers of India. We think that if you're going to choose emerging markets, is the place to park assets. And also, one slide left, guys. The Nikkei, okay, crystal ball prediction. The Nikkei 225 extends to 55,000. This particular chart focuses on Japanese valuations. Japanese valuations remain far below US multiples. So again, continuing that diversification conversation, both geographically, asset class. Japan offers serious value, even though markets have moved to new highs. And I'm going to end now on our final sort of positioning. Of course, this is an AI generated photo. Again, you're not going to be as excited as I am, but this is Chris Saunders on the right-hand side. Looks actually slightly better looking than me in real life. And of course, I'm sort of treating the AI trend as my friend, which is why I'm in an AI generated world. Zuckerberg, Musk, Tim Cook, and the rest of the lads, because the AI trend is still your friend. Being ex-AI or being out of AI, we're not just talking Magnificent Seven here. We're talking companies which benefit from the productivity revolution. Being out of AI is contrarian. We are not contrarian. We give broad diversification across asset class, geographic exposure, and of course, currencies. Thank you very much for the opportunity, guys, and for tuning in. Hopefully it was useful for you all. Thank you, Linda, for the opportunity.
No, thank you. Just a quick one, just to say, those that you know Chris obviously know that Chris is based out in LATAM. So I'm presuming it's 4 or 5 o'clock in the morning, and you're looking very fresh and you're very on it. So
it's
really
the light.
Appreciate you.
It's the light. I'm in Europe next week, of course, but we wanted to get this nice and early. But no, it's the light, I can assure you. 5:40.
So we have a couple of minutes left, and we have quite a lot of questions. But just for everyone, if we don't get through to your questions, what I'm going to do is I'm going to send them over to Chris anyway, and then Chris, obviously, you can go back to the individuals directly. But I'll do my best, Fiona Bruce, and try and get through as many as I possibly can. So there was a couple similar ones around the crystal ball and your sort of predictions, and there was 2 or 3 that sort of were asking what do you believe will be the ones that sort of come true, or most likely to come true or come to fruition in 2026.
Okay, so it's really important to ensure that the predictions, it's you're on a hide into nothing. Okay, so the crystal ball predictions, even though we've done, I think in 24 we had like 6 or 7 out of 10 correct, a little bit less in 2025. But the point that I'm making is that it's to give you low probability events which could really move markets and talking points. To answer your question, the more sensible ones are Japan. I think Japan is a great place to invest, even though we've gone to new highs. The valuations are still exciting. Japan would be one that I think actually is going to go to new highs. So that would be the more sensible one, I think. And probably the one that I disagree the most with is that we will see dollar strength in comparison to GBP weakness. I don't think that will happen. I think that is something that wouldn't happen. So Japan would be my, if I'm gonna sort of bet my life on something, it would be Japan is the crystal ball prediction, which continues.
Okay, brilliant. And then there was quite a few questions around diversification, because you mentioned throughout your slides about sort of diversification sort of coming back, and what does that mean from a portfolio construction perspective?
Well, that's a good question, actually. Okay, so the words I often use when presenting it, maybe a year or two, maybe this time last year, was diversification was dead. All right. All you needed a year ago was investment exposure to US assets, okay, world equity, basically, world equity, which would then mean 70% US assets, which would then mean 35% six stocks. That's all you needed because that was what was driving returns 23 and 24. In 25, diversification come back into play. Broad diversification come back into play. So the assets which outperformed were things like geographically, you needed emerging markets, you needed European equities, you needed to have a broad geographical base. Also, asset classes, what outperformed? Well, our biggest performers in the New Horizon Global Balanced Fund, precious metals, gold, silver were the best performers. Carbon offsets, okay? Again, additional diversification, specialist property, infrastructure, all of these, if you like, assets which were out of favor for years due to interest rates being hiked, because the trajectory is lower, the broader diversification and the broader assets are really beginning to add value. And you'll see it with managers, okay? If you're in Magnificent Seven, you think, right, I've got to broaden that diversification. And now there's an argument to be able to do that because we're seeing broadening growth in earnings, both through the S&P 493, or through market capitalization, so mid cap, small cap, and then, of course, geographically in Europe, emerging market, tech stocks, this sort of thing. So it's broadening both asset class and geographic exposure, and also broadening your currency exposure or hedging, because these are the real drivers of returns that we've seen over the last, well, 2 years now, well, 18 months, sort of 25 and sort of end of 2024.
Excellent. And just conscious of time, so I'll try and sort of squeeze one more question in before we wrap up for everyone. And there was a really good question on the extent so what extent do equity markets distinguish between the rate cuts driven by the sort of economic conditions that are ongoing at the moment and those that are perceived as political or fiscally constrained? So particularly in terms of the Fed independence, your AI slide with Trump attacking Jerome Powell, basically. So what are your views on that sort of extent?
So it broke a little bit then as you were asking that question. Could you sort of could you re-ask me that question? Sorry.
Yeah.
So it was quite a long one as well, wasn't it? So
It was a long one.
Parts of it as well.
But I do think it's an interesting one. So summary, so you've got the equity market. So what extent do the equity markets distinguish between the rate cuts and the sort of economic and political constraints that are going on, sort of referencing the sort of Trump attack on Jerome Powell?
I mean, look, that has to be one of the risks, is that, yes, interest rates are coming down, okay, which is a positive for equity markets. That's a good breeding ground. But what is happening, of course, is the Fed independence is being, if you like, attacked. That is not good for the view of the US, institutions and checks and balances is what the US is all about. Okay, so if you're putting these under threat, then that, of course, is a risk. And that arguably is what is driving, what is a contributing factor to potentially further weakening within the US dollar. So look, there's no doubt about it. The Trump administration is pro-markets. Trump is almost one of the tech bros. I didn't want to add him to the final slide there, you know what I mean? But he is one of the tech bros, isn't he? He sort of supports cryptocurrency when he needs to. So it's in his interest to support markets, both crypto, both S&P 500, and he's really trying to sort of manipulate the Federal Reserve to drive interest rates down to 1%, because again, that is fuel. So there's a balance there, isn't there? There's interest rates coming down naturally because inflation is coming down, but it's the losing face or confidence in the US, which again is a counterbalance to that, which again is then weakening the US dollar.
Okay, brilliant. There was a couple more questions, but what we'll do, as I said, we'll send them over, and then if you have any other questions, then reach out to Chris direct. Obviously, from our perspective, we have the New Horizon models on platform, and if you want any more information on those, then please give us a shout. Reach out to your usual ISM sales manager, and we'll be able to point you in the right direction or point you towards Chris. But just
Absolutely.
Brilliant. Okay. So thank you so much for your time. Again, as I say, appreciate the very early start. And as always, really, really interesting, and your AI generated slides were fantastic. So it supports
Thank you so much for
your
the
belief. So
explanation. I needed that
yeah.
because everybody else just takes the mick out of them. Just as a 10-second sort of, if you do want to have further information on all of the market, on all of the crystal ball results from 2025 and all of the 2026 predictions, please just log into the portal, which we can give you access to, which will allow you to generate this. It's a super long document this quarter, okay, but it'll take 2 seconds for you to do, and it'll give you all of that information. All right, so
Yeah.
just go and drop us a line. But look, massively grateful as always, Linda, and I think I run over today, so I do apologize, and
No,
hope
absolutely
you.
fine. Yeah, and also going forward, appreciate everyone's time for dialing into our first one of 2026, and I really look forward to welcoming you on future webinars. They're held on a monthly basis. The best way to find out what's happening and who's talking and when they are is to go onto our LinkedIn page, and if you subscribe, you'll see all the details there. We have our monthly pulse newsletter, so the details of the next webinar will be enclosed within that. But it just leaves me to thank Chris again for your time. Thanks everyone for dialing into this first one. Looking forward to a good year of webinars and joining, and hopefully having you all join us on the next one. Thanks very much, everyone. Have a lovely day. Thank you very
Thank you.
much.
Thank you. Take care. Bye bye.